to another live Propenomix supplement. I'm Adam Lawrence, and this week's I called the final stretch as we enter the last month of the year. So if you've listened before, you'll know I like to start with a quote, and this week's was, "The word Advent means expectation. What Advent can do for us is to create a sense of hope." And that was by Louis Giglio, the author. So, before I get started, I just want to encourage you to buy one of those final tickets for the next Property Business Workshop. It's Thursday the 16th of January 2025. This time round, Rod and I will be covering productivity, planning and financial accounting and bookkeeping. Why? Because we constantly see property businesses struggling with appropriate financial reporting, accounting and bookkeeping and making the same mistakes time and time again. We want to help you get a complete handle on the financial performance of your company or group when you aren't at a level yet where you can afford a CFO or a financial controller. Set it up correctly once and then iterate from there. As always, it's going to be an action-packed and content-filled day which will stand alone in helping to advance your understanding as a property business owner. The link for the tickets is live, and there are only 3 super early bird tickets left. They've got a genuine 25% discount on them, and it's at bit.ly/PBW5. So, welcome to the supplement. I always enjoy these ones where we round up on the last week of the calendar month. And of course, also we've got the bonus of the 2025 predictions starting to filter out there into the media. I'll look at the predictions over the next few weeks in general, with my usual sceptical, scathing tone, because they're rarely worth much, let's face it. That's a bit unfair. Some are, but many aren't. But we must remember, when we're investing in property or anything, we're all predicting the future, because we're predicting that asset class is going to go up in value, is going to be worth more, and is going to be worth holding on to. Otherwise, why are we doing it? So, what will also be interesting is to look at the economic predictions following the budget and a month of activity, or lack of it, and then put the Propenomix spin on them, because the predicted 2% growth in 2025 at this point looks a complete impossibility to me, for example, but let's judge that over a longer piece of analysis rather than just my gut feel. This week for the deep dive, I look at the Zoopla House Price Index report, which came out late this week for October, and also the Bank of England Financial Stability Report, which is a 6-monthly event. So now I'll go into the prescribed format, and that is starting with the real-time market. Chris Watkin, whose stuff I read religiously, asked himself that question once again: what's currently happening in the UK property market? This report was from a more typical week, although all figures this week have pointed out there were a large number of transactions in October. So you'd expect November's transactions to have suffered a little, if you accept the argument that many were brought forward to complete before the budget. Chris is a guru of, I'd say the guru in fact, of estate and letting agency stats, and he continues to forge on with new ways of looking at the data and stats in near real time, for which I'm certainly grateful. He reports on the UK portal data. It's aggregating for him by 20 EA on a weekly basis, and I love these real-time snapshots and pictures of the market we can piece together. There's no better way to stay informed. We have to analyse what has happened, but only really so we can meaningfully try to predict with accuracy what will happen. Number of listings nibbled down to 27,200 last week, which is to be expected as we get to this time of year, December. Purgatory for estate agents. Happy territory for buyers, but once again, a higher number of properties listed than in the equivalent week compared to all of the other years for the last 8, which is Chris's sample size. You could almost say the same about almost all of this year, though. We've had 1.6 million property listings so far, and that's the highest over that whole period. It's even gone off Chris's graph in the stats. And the market looks healthy enough for this time of year. In a flash, the 3.6% mortgage deals we did have are now clumping more around 4.25 for the owner-occupiers. It's not horrific, but that's not much progress downwards in the past 12 months, although many have managed to snag a 4% or less this year if they've had some good timing on their residential mortgages. We're talking about a 5 basis point reduction compared to last week, roughly, looking at the best buys. Sold subject to contract stayed near 24,000 this week, far higher than 2023, 21% higher for the same week, in fact. And we're even further ahead of the pre-COVID averages than we have been. We're 8.6% above the 17 to 19 year-to-date average. The fall-through stayed well under control, so I think the budget can be put to bed on that front now. The fall-through rate was 40% for 2 months after the Truss Kwarteng mess of 2022, and the 7-year average is 24.2, compared to around 25% for this week. And net sales still look good. The only year with more net sales, which is gross sales minus fall-throughs, was 2021. So it's a healthy print on the year and 6.1% above the pre-pandemic average of 2017 to 19 now. There's more houses on the market now though, about 725,000 or thereabouts on the market as we speak, than at any single time over the past 8 years. And in fact, it might be more than that. Chris himself will know the answer to that one. It can't possibly be that landlord sales are influencing the amount of stock out there, can it? What else could it be? Well, expect a drop come January though, as people make decisions to give up if they can't get the price they want. Let's continue to monitor. Now I'm going to repeat a section I've chopped around over previous weeks just in case anybody missed it. Remember these newly reintroduced stamp duty bumps, not exactly cliff edges, but 125 to 250k and 300 to 425k. I've said over the past fortnight, they're going to nudge behaviour the other way around in the first time and secondary markets, of course, in Q1 of next year, and possibly before Christmas if people are very well organised, but I doubt it. Everyone paying over 125,000 is paying the extra, first-time buyers aside, in that 125 to 250 band, and first-time buyers will likely be the most motivated because the marginal band between 300 and 425 is 5%. So there's up to £7,500 of extra cash to find or borrow from Bank of Mum and Dad there. And that's going to force some transactions through before April the 1st, 2025. This will be prevalent in areas where first-time buyer stock is over that 300,000 mark, of course, and that's not the case in a lot of the country. Around 60% are probably under or around that sort of mark, but geography will be your clue there, of course. You would expect from the starting point the impact to be more volume before the 1st of April and then less volume after, as the market adjusts to the transition, with future volume dependent on the pace of rate changes. Use this wisely though, don't compete if there's a scrum in Q1, stick to your guns with a big effort in Q2 at the beginning to get the reductions that will pay the stamp difference 3 times over. Remember what this also means for anyone disposing of any stock. You've got to list your sales wisely, list now or soon. Certainly prepare to list on Boxing Day, now we're there, in December, and get carried away with the usual hype, or make an impact on the first weekend of the new year after the kids are back to school. It just depends what you're selling. Line up decent lawyers on your side as well. It does look like there will still be plenty of stock on the market. On the investment side though, I'm still seeing and hearing tumbleweed for the vendors right up until Christmas time. Stay keen, keep your eyes open. There's bargains out there and a ton of lotted stock that isn't even being viewed, let alone offered on. This window of opportunity won't last long, but press your advantages if you're buying. Auction primarily is where I'm seeing that, but because that's a big focus of our operation. Open market won't be much different, I don't think. One more takeaway from the real-time desk though. October's sold subject to contract figures showed £346 per square foot. That was 1.5% up on July. In spite of the overall bearishness, things are moving north. Next week we should have November's figures. So my 5% capital growth prediction for the year in the UK housing market looks like it might settle around 4% or in the low 4s. I won't be unhappy with being less than 1% out though if it does shake out that way. Won't be too much of a bite into inflation for the year though, will it? In the end. This will be judged on December's ONS print, which will not be out until mid-February, of course. You can hear a pin drop while we enter the macro section. We go back to the consumer and business confidence figures that we didn't have room for last week. The retail sales also told us a story. And then we had the Bank of England money and credit report, including the mortgage approvals, and I never missed that one. And then we had the gilts and swaps, of course. Confidence. It was a surprise when consumer confidence ticked up in the highly respected GfK survey last week. We were expecting a -22 and printed a -18. But every component of the index improved a little, aside from the savings index, which is good news for the economy because it means people would prefer to spend than save. Consumers are a bit brighter than the past couple of months generally, and they're a lot brighter than they were in November 2023, although they still think the next 12 months will be as bad as they thought the next 12 months would be 12 months ago, if that makes sense. It does seem though that the consumers haven't taken the budget anywhere near as badly as the businesses have, which is perhaps not a surprise. The major purchase index, which is the one that deserves singling out, is much better than it has been for many months, and you would think that's a good sign for consumption and growth. It's a reason to be cheerful for the wider economy. The Industrial Trends Survey was less positive, although it's still printed higher than the consensus expectation. The near-term picture is an expectation of output volumes rising in the next quarter, though. Order books were reported as below normal, but that seems to be being pushed onto budget uncertainty rather than budget after effects. The overall CBI summary was positive and looks to find a way forward after a difficult budget for business. The CBI Distributive Trade Survey runs alongside the sales retail figures, and guess what? Both performed worse than expected. A poor November was reported, although these reports were done before Black Friday, so the day that falls is important, but not enough to save the figures. There's a sharp decline in sentiment in the sector, pointing to lack of investment, and the last time the industry was this gloomy was November 2022. Say no more. The budget will hit them very hard, there's no two ways about it. Jobs will be shed and shops will be shut. If you know anyone who works in retail, or you work in retail, I would get them to get another job as soon as possible or start retraining. That's genuine advice. The October retail sales figures from the ONS cited budget uncertainty once more to explain some of the 0.7% month-on-month fall. The annual figure was still positive at 2.4%, so just ahead of inflation. Clothing took a huge hit, but mostly because October was so mild. That sorted itself out in November, but online and offline fared equally badly in October. But overall, manufacturing looks to be keeping calm and carrying on, and retail doesn't have an answer for a 60+% increase in business rates and an 11% increase in the cost of staffing. So, money and credit report. While we touch on the Bank of England, and before I start on the report itself, there were a couple of speeches in the past week, one from Claire Lombardelli, who's the Deputy Governor these days of Monetary Policy. She's the main player, realistically, who the Governor is influenced most by. This was her first speech as an MPC member and is concerned about risk to the upside for inflation. She doesn't want to get too bogged down in initial PMI readings, and she shouldn't. Never worry about 1 month, I always say that. It likely just reflects a sector who are licking their wounds after a bad budget for business. But she did concede the bank will respond if deterioration continues. So, they might need to cut rates, but she doesn't want to quickly and prefers a slower, gradual path downwards. Sounds very sensible to me. Regular listeners will have picked up that I'm a bit worried now that when we get down to about 4% on base, we're going to lose pace completely on the cuts, and that might be the new normal. Worried is a big word because that is a sustainable rate of interest, ultimately. In the longer run, the trend will still be downward because growth is so hard to come by. But we're starting to talk about the tail end of this parliament for us to have a case to go much below 4% base in a scenario which I now see as definitely possible. So I'd say maybe 30% probability of that playing out in that way. The dove of the committee also spoke this week, Dr. Swati Dhingra. She's had some really interesting takes over the past few years, and I often disagree, but I do see a lot of merits in her points. Her take on the Trump tariffs, which already seem to be the subject of changing goalposts, she pointed out that if tariffs do go up to 60% on Chinese goods, then the Chinese might cut prices elsewhere in the world in order to make up for the drop in volume in the US. But she does accept, though, that it depends how other countries respond. If they go tit for tat with tariffs, for example, as many are threatening to. And in reality, we need to wait and see what happens. But the ultimate point is that global inflation, on the back of any tariffs imposed, is not a guarantee. Okay, so the money and credit report then properly. Net mortgage debt increased by 3.4 billion in October, a healthier figure than we've seen this year. And net mortgage approvals moved to 68,300, which is the sign of a healthy market indeed. Finally, we've breached that 65,000 number, and this is the best months in August 2022. This isn't budget driven because those approvals are unlikely to have completed before October the 30th, although perhaps the sales were budget driven in the first place and the prices offered were reflective of that. Although it doesn't seem to be the case because we've seen prices rising in October apart from anything else. But there we go. It's all a bit speculative really, but it just looks like a healthy market overall that we'll continue to monitor. But there was a huge increase in the net flow of money to households, increasing by £20.2 billion. Enough to fill a black hole, some might suggest. The best month since December 2020 for the households, and higher than any pre-COVID figures on record. And remember what sort of transfers were going on in December 2020 directly from the government to the households. Maybe it's people cashing up before the budget. That's a less speculative comment, I think, because there's got to be a reason for it. People selling before potential CGT rises. That's what I'd put that huge increase down to. So overall, the credit report looks particularly healthy, and I'm sure there will have been some tax revenue generated on the back of that cashing up, which we'll soon see some headlines about. So a bit more to be cheery about. The effective interest rate on newly drawn mortgages in October was 4.61%, down 15 basis points. This will be coming back up in a few months' time, of course, when the budget gilt bump kicks in, but it's still good to see. The outstanding debt stock moved to an average of 3.78, so that gap is now 5/6 of 1%, or 22% higher on the draw rate than on the existing rate. But still, this is a fairly big close of the gap, which is needed. 3.78% is the series high for outstanding debt, which tells you how long that series has been running, not really long enough. Lending to large businesses continues to limp forward. Lending to small ones continues to decrease, but at a slower rate. And that's the tale of the tape since the third quarter of 2021, really. It should be no surprise that UK SMEs are struggling. They either can't get the money from the banks or they can't afford to borrow the money from the banks, ultimately. But let's see what happens with that net flow of household money. Will it just be flowing outside of the UK? Hopefully not, for the sake of the economy. But overall, the economy looks healthy enough from a credit perspective. So, a happy gilt week? Black Friday sales on the yields? Well, it was a down week on the back of the R word coming up, just a little bit in some of the press. We had to have politicians admitting that things were slow, things were tough, etc, etc. But of course they're more interested in who's to blame. We opened the week on the 5-year gilt at a 4.234% yield and closed at 4.1. So we're comfortably back more towards the middle of my range, which is 3.75 to 4.25, given overall market conditions at the moment. The swap closed well under 4%, 3.829 on Thursday, against a gilt close of 4.156. So it's now cheaper than before the budget. The bearish top discussed last week does indeed seem to be in, or are the yields falling in expectation of possible rate cuts in the face of a recession? That is a much more likely scenario now. I said last week, well, expect further bad news economically as we approach Christmas and thus lower yields, but how much lower? And we've had an immediate result to the tune of 15 basis points. Pricing can move to 5.8 or thereabouts for no-fee 5-year limited company fixes, and about 8.3 for investment grade gross yields on a typical UK house that you might want to buy as an investment property. It's probably about 0.75% above the typical yield right now in the UK. Personally, at the moment, I'm sticking to a simple rule of thumb. Debt's going to cost 6%. Houses need to yield 8.5% gross yield, if you prefer to analyse on yield. Now, I actually prefer to use a suite of other metrics, but for simplicity, and because the entire industry talks about yield, I stick with yield in these podcasts and blogs. So, over to the deep dive. Zoopla and their house price index report then, first of all. Zoopla quietly accepted their bearish prediction for 2024 was incorrect. Their prediction was a 2% drop. They now see UK prices up 1.5% in the past 12 months, with a couple of months to go. Now, all the other indices are quite a long way above that 1.5%, but there we go. They say that on Zoopla figures will be 2% up. So they were inversely out, or they're about 4% out. Not terrible, but really getting the direction wrong, I think, was their biggest mistake. Now, they cite rising incomes. Well, as I said, we knew that at the start of the year. They weren't suddenly going to go away into nothingness. Nothing really changed from predictions on that front. And they also cite lower mortgage rates, which, again, being sensible, everybody knew if they followed the yield curve down, apart from anything else. But there we go. They even go as far as to make the statement that the housing market has now largely adjusted to higher borrowing costs. I'm a bit worried this is an overall misrepresentation. The truth is that they didn't appreciate the correlation between the price of credit and the price of houses, and that's the misjudgment that led them to predict a drop in prices when a rise in prices was more likely. They're now predicting 2.5% for house prices in 2024, with 5% more housing transactions, which they see at 1.15 million. They expected 1 million sales in 2024. In the breakdown, they show that terraces have performed best, up 2.1%, semis second place at 1.6%, and then flats and detached overall being very limp, 0.3 and 0.2 respectively. Zoopla continues to overemphasise the cost of debt as a driver, when these correlations are not as clear-cut as they imagine. I've seen many estimates of this over the years, and I came across a good blog article, which is a good attempt at putting a lot of this into context, including the difference between places where there's just no more developable land, so for example Islington in London, Of course, you can always go upwards, but there's no more actual, downstairs land to develop on. And also where there's an awful lot of land, so say up in Northumberland, for example. And that's the Bank of England Underground blog. It's bankunderground.co.uk if you want to take a look. And the link is in the written supplement, which is on my LinkedIn, or on the Partners in Property blog on the partners-property.com website. So Zoopla now feels ready to conclude that lower mortgage rates have supported the return to house price growth. It isn't really true in my eyes. Inflation ravaged real prices and incomes came right up. That's a much better explanation in my view, especially considering that, as I'm saying this, the gilts are in a very similar position to 12 months ago. Although it is fair to point out we did have a period of mortgage rates below 4%, which we certainly didn't get to enjoy in the second half of 2023. The yields haven't moved a whole lot since then though when you look month to month, so it isn't much of a conclusion in my view. It's more fitting their ongoing narrative. And then there's one more discussion of the north-south divide, as rates of growth have really levelled up in the past couple of years, as affordability at the higher rates really does impact what's going on in the south of the country. So, the report then cites some interesting OBR data, a 15% increase in household disposable incomes between 2022 quarter 2 and 2022 and 2022 quarter 4. So most of them swallowed by inflation. That's 2024 quarter 4, sorry, to be clear. Most of it was swallowed by inflation, you might say, but with house prices only up 1.5% in the same period, they do seem to have finally reached my conclusion that income growth has been the cause of repair, although they don't seem to want to say it out loud, preferring their mortgage rate argument. Borrowing costs are expected to remain about 4.25%, Zoopla says, although the Bank of England's draw rate at 4.61 for October was the lowest for some time, remember. So perhaps they're referring more to the best buy rate in general. And Zoopla notes that the stress test of 8% is the true choke point at the moment, although sadly they missed the chance to conclude that longer fixes could completely remove this choke point. The government could fix this fast. So, let me spell it out for you. Introduce 25, 30 and 40-year fixes. Make them portable, ideally. Make the government the lender. Offer these at gilt yield plus margin. Margin could be as low as 0.5% in reality, but let's make it 0.75% or 1% and not be scared to make a profit. Unlimited funds available via the gilt markets without disturbing them at all, because these would be secured loans for good reasons. Remove what looks relatively unnecessary stress testing people at 8%. Sure, it's possible, but we've dealt with 500 billion of stimulus and not seen 8% rates. So what are we really protecting against there? 6% would be much more appropriate in the vast majority of cases on the balance of probability. Alright, remove the government out of the equation. There are already lenders offering these, but they're more expensive and their marketing communications are completely and utterly deficient. What they should be saying is things like, do you want to buy a house that you can afford? Have you been told you can't afford a mortgage but you know you can? Take out all the risk and fix for your whole mortgage term, etc, etc. Okay, I'm not a marketeer, can you tell? Anyway, a brief segue really. There's a business in a box there for someone in my opinion. Zoopla's take is an expectation for lenders to innovate on how they assess affordability for fixes of 5+ years. Now we really have stopped talking about rates coming right back down, I think the product team should be getting on with it. The early bird, who really isn't that early, could absolutely clear up here. The next section cites their model, which said house prices were overvalued by 40% in 2007. In 2022-23, they suggested prices were overvalued by 16%, but are now undervalued. They see prices growing by 7.5% by the end of 2027, which I think is a vast underestimate, given that income growth should vastly outstrip that number, and in my opinion, so will inflation. Not vastly, but I don't see it as being as low as 7.5% over the next 3 and a bit years in total. And then they go on to analyse the stamp bump, as I've been calling it, April 25. For FTBs, it moves from 20% of them paying stamp duty to 40%. For homeowners, it moves from 49% to 83%. So nearly everyone will pay £2,500 more, and this is why it's going to distort the market next year. They expect this to act as a drag on house price growth, and I'd be inclined to agree. But I also think it's a drag on transaction volume, though, which they don't seem to agree with. I mean, there's plenty more in the pipeline now compared to 12 months ago. All in all, an interesting report with some really good spotlights shone, and whilst I don't agree with all of the analysis, it isn't like it's a million miles wide of the mark. I remain appreciative of what Zoopla do, compared to many of the larger property organisations who peddle poorly researched claptrap. That leads us to the Bank of England Financial Stability Report. It's always a cheery piece. Not really. They lead with, global risks remain high, the outlook has become more uncertain and riskier. I see where they're coming from, but I'm not convinced that I agree. I appreciate the uncertainty around Ukraine, but is this markedly different from 6 or 12 months ago? Decades of sabre rattling from Putin lead us to be sceptical. Trump's election, a wild card for sure, but nobody messes with the USA does feel like a sensible conclusion with the orange man in charge. The tariff question is one we've already touched upon, but already that chat is being softened and being made more about migration and border control. Elections are out of the way, mass uncertainty is gone, so is the budget. It is now what it is. I'm inclined to disagree with the bank's conclusion, to be honest. But there is, however, a lot of debt. France has been wobbling in the past week, in case you haven't heard. Huge debt piled on by the pandemic is not only a UK thing, but no one ever seems to mention the pandemic anymore, and there's just zero tolerance in today's society for it to take decades to recover from the massive government measures that were deployed worldwide to counteract what was going on. When you look at the yields versus the strength of the underlying economies, a lot doesn't make sense. But there is the UK dividend of having a more stable government, regardless of their experience level or competency, versus some of the spectres that are lined up to take over some of the European countries in the next couple of years. Here's a spoiler alert for you. They won't do what they said, and they won't be any good. The bank then makes one of its rare mentions of property. Some corporate borrowers globally continue to face the challenge of refinancing existing debt at higher interest rates. This challenge is particularly pronounced in the commercial property sector. And this is why it's always cited that commercial property is much more rate sensitive than resi. The sector really papered over the cracks and handled the repricing of interest rates really well, to be honest. They did exactly what they should have done. They kept calm and carried on. Much office space is really now recovering from the reports that I read, and so big problems, hopefully, have mostly been avoided. Of course, there will be exceptions. But then probably the most likely and concerning part of the report. A sharp asset price correction could increase credit costs and be made worse by weaknesses in non-bank finance. This is a concern. However, bond prices are pretty subdued, I'd suggest, and equities in the UK have hardly charged forward. Adjust the FTSE for inflation, and the real return has been woeful in the past 25 years. UK capital has flown offshore for better returns, but it becomes a self-fulfilling prophecy. Investment in UK companies couldn't get a lot worse, and quite a few overseas companies, particularly from the US, are specialising in the purchasing of UK assets because they know there's a Brexit discount still available, which some mention as 20 to 25%. Now, the non-bank finance piece is of course a concern, because so much SME financing is done by non-banks, mostly because the banks want big ticket stuff, not the smaller loans. These loans would still make our eyes water, of course. It's very surprising when you look into the books of SMEs that have healthy balance sheets, 7-figure EBITs, etc., and still see how hard it is for them to get financing. Then, some commentary on the resilience of UK households and businesses. I always like to put it into context in this way. When people start talking about the bankrupt nature of the UK government, the government's elected by the households, and to an extent by the businesses. The government has revenues of around 1.1 trillion per year and rising. It owes around 2.5 trillion, so let's call it 2.5 times revenue, for the sake of a figure. The households have more than 10 trillion in assets, and the businesses are in the same position. So this, I think, helps a lot by putting those figures into context. Debt relative to income has fallen in the past 6 months. Arrears are low by historical standards, even though rents and mortgage payments have risen. Refinancing at the business or household level will cause some problems. The next chart was one that I shared this week, looking at how mortgage payments will change by the end of 2027. Why is that the relevant time period? Well, that's the end of the bank's forecast period. They use 3 years, but it's also the end of the cheap money era. Yes, there are some genii and some luck boxes who fix for 10 years or even more in 2021, but this is a tiny handful, far under 1% of outstanding mortgages. So we can, by the end of 2027, consider that all the cheap debt has gone, it's either been paid off or refinanced at a higher rate, or somewhere in between. So the pain, or really lack thereof pain, is well graphed. 50% will see an increase in mortgage payments from here, with 5% seeing a payment increase of more than £500 per month. 26% will see an increase of between £100 and £500, what I would call a material increase, probably swallowing any pay rises after frozen tax thresholds when you include the increase in food prices, energy prices and the likes. Unless there's been major progression in job roles, of course. 19% will see a rise of up to £100 a month, which we can assume they will have covered in rises in income to the interim. I'd suggest that basically all of these households are 2+ years into a 5-year fix, basically. 23% will see no change in their mortgage payments. 27% will see a decrease in payments, including 1% seeing a more than £500 a month drop, and 8% seeing a £100 to £500 drop, which is material. So that's a ratio of about 3 to 1 of those seeing a material drop versus a material rise, with 3 times as many seeing a material rise. 18% will see a less than £100 per month drop, which again we'll consider as not material. So that's 31% of households with mortgages affected badly and 9% affected well. Remember, this is just that subset of owner-occupiers with mortgages, and that's only 28% of the households as it is. So about 8.7% of households have got some pain coming, and around 2.5% have got a benefit coming in the next 3 years. Can we assume the same for leveraged landlords? Well, possibly. If we accept around 60% have a mortgage in the buy-to-let sector, and figures do vary, but that's about right, then around 3.5% of rental households have a material shift upwards in rent yet to come, depending on how the landlords manage the asset thus far, of course. And around 1% will have a landlord who gets better off and may pass that on to the tenant, not in a rent decrease, but in lower rent increases maybe. Although not many businesses work like that, of course, so it just depends on how professional or how kind they are. So you can see only around about 15% of households have direct pain still to come from people dropping off lower interest rates. That keeps it very manageable, even if a large percentage of that 15% got into trouble, and that's unlikely. Historically it tends to be well under 10% of those. Even if 1.5% of households were in trouble, many have already been cutting consumption in preparation for higher payments, and also have been making savings, which they might use to overpay mortgages. These numbers are taken as at the swap rates on November the 12th, 2024. This was quite a high swap rate for 2024, peaking really as the US election result had filtered through, and was certainly north of 4% on the 5-year and the 2-year. Today's look a bit calmer, and my expected range would see this graph as a close to worst case scenario, certainly one that's probably only got a 10 or 15% chance of playing out anywhere near that level. As the rate comes back a little, the more those percentages will change over the coming years in favour of the households. So I'm saying it's quite a good, realistic worst case scenario, I think. Consumer credit grabbed a few headlines this week as a few gurus who don't read reports like this decided to use them as headline grabbers. The real tale of the tape is that consumer credit balances are now 15% of income, well below the pre-2008 peaks of 25% and the pre-pandemic levels of 18%. So nothing as yet to worry about, although there's been healthy growth in the sector as the tail of the cost of living crisis still worse. The bank then recognises what we knew and always knew. By definition, a lot of this would always be true, particularly about low-income households. The more interesting study would be how easily, or not, the same household moves in and out of the income bands over time, because the bottom 10% is not the same as following the same households over generations, for reasons that I hope you understand. Nonetheless, the bank leads with pressure on renters and lower income households continue. On average, savings buffers for renters have increased in the 6 months to 2024 Q3, but have decreased for lower income households. NMG survey evidence suggests the share of renters who have fallen behind on payments has continued to rise, as rents have risen substantially alongside the increase in mortgage borrowing costs. The NMG survey also suggests some renters and lower income households intend to run down their savings in the next year to deal with the increased cost of living, making these groups less financially resilient. The challenges faced by renters and lower income households are also borne out by intelligence from the bank's agency network. None of this will be surprising, and as per my rent forecasts, which I'm confident are far more accurate than any of the larger forecasters, who don't even make clear whether they're talking about new rents or existing rents for a start, this trend will continue for a couple more years at least. This is in concert with higher mortgage rates for a large percentage of landlords who use mortgages. What's the response been? Well, freeze housing benefit, of course. A silly play by Labour, but of course they appear ideologically opposed to it now. In their last run of parliaments, they were perfectly happy with it, of course. But one more piece I want to draw out before bringing the report summary to a close. The stress test. Now don't worry, remember, this is a stress test. So, the scenario they look at, one of them is global aggregate supply shock from what would essentially be a world war. They don't say that, but the severity of what they're modelling leads me to conclude that's what they mean. This sees another inflation shock similar to 2021 and sends the bank rate to 9% for 12 months, falling thereafter. Yikes. On the flip side, the other scenario is a global aggregate demand shock, a global recession. Inflation craters, bank rate drops to 0.1 quickly and remains below 0.5 for 2 years. Now, before you rub your hands at that scenario, remember unemployment might double or more, and you might have a lot of tenants who lose their jobs and cannot pay their rents. So this would lead to, on either scenario, GDP down 5%, unemployment up to 8.5%, and house prices down 28%. Similar to the same parameters they use every time they do a stress test. So as I say, be careful what you wish for. These are dramatic scenarios, worse impact than the Great Financial Crisis, for example. These are the scenarios where you plan for a large portion of your portfolio to be on the local housing allowance overnight. This is where your very boring single-let style strategies are still very robust, and that's one of the reasons why I keep such a large percentage of my portfolio looking and performing like this. Don't spend too much time worrying about it, but it's worth noting where the stretch high in base rate would be. If 9% base is going to bankrupt you, then now is the time to do something about it, not sometime down the track. Fix the roof while the sun is shining, or at least while the roof isn't letting water in. Before I call it once more for this week, one more reminder that tickets for the next Property Business Workshop are out. Thursday, January the 16th, 2025, with some great subject matter, planning, efficiencies, financial accounting and bookkeeping. Not how to use Xero, but how to ensure reporting is set up correctly and how to monitor it on an effective, ongoing monthly basis. Come along and also get your strategic planning sorted out, and your January kick up the backside comes as part of the package as well. We've still got these super early bird tickets with a 25+% face value discount on them. They are numbered, there are only 3 left. These events do sell out, so I hope you snag one of those last ones. Rod and I hope to see you there. That's at bit.ly/PBW5. There's also a link down in the notes. So, as you'll know, there's only one way to deal with all of this ongoing noise and excitement. Keep calm, always listen to the supplement, and carry on. Thanks for listening.